Welcome to the Bank News webinar series. My name is Patten Rodriguez with Bank News Media, and it is my pleasure to host today's webinar, 3 Considerations for Your Financial Institution, sponsored by BOK Financial Institutional Advisors. BOK Financial is a top 25 U.S.-based financial services company. BOK Financial Institutional Advisor Group provides products and services to financial institutions across the country, including interest rate risk reporting, model reviews, deposit studies, and fixed income portfolio management. As a reminder, this webinar is being recorded and everyone registered will receive an email notification when it is available. We will have a question and answer period at the end of the webinar, so please submit your questions using the question function on your screen at any time. Our presenters today are Marc Gall and Patten, who are both Vice Presidents of BOK Financial Institution Advisors Group. Today, they will be discussing the economic and interest rate outlook for 2019, considerations for year-end investment portfolio strategies, and a road mapping asset liability management. Thank you again for attending our webinar.
Good afternoon. My name is Marc Gall, and I'll introduce Brett Patten as well.
Good afternoon, everybody. Thanks for joining us.
So a nice cold day here in Wisconsin. As we mentioned that we'd be using some live polling, if you do text Marc Gall 887 to the number 22333, that'll get you entered. Once we get to the live polling, we'll add about 30 seconds to get some live results. Just want to keep this interactive. I know that sometimes webinars can get a little bit difficult to focus on for some length of time, but our goal here is to keep this relevant to your financial institution and give you some tips that you can take away as you look into 2019. We've got our disclosure page, so all of the information here is Brett and myself, our opinions, and not necessarily the opinions of our company. We would like to show a lot of the information here as illustrations, and if there is something specific to your institution that you'd like to see after, we can certainly work with you on a one-on-one basis. So you can see us. We've got some pictures here on the slide right now. We've got our contact information that we'll pull up again at the end of the presentation. And then we also have a website if you have any more questions about some of the products and services that our group offers, bokfinancial.com/institutions. So getting started, we mentioned that the agenda for today is going through the economic conditions and outlook for interest rates, really getting a set on what the budget might be and what interest rates you want to use for forecasting out income statement into next year. Also looking at growth expectations for the loan portfolio. And then as we go through the economic conditions, certainly looking at what the economy might do as it relates to the ability for your institution to grow or have strong profitability going into next year. Walk through investment portfolio management strategies that you might want to consider into year end. And then finally finish up with some asset liability management information. So I'm just going to clear this out, but I just want to see participant profile of who is on the call today. And the reason that we want to do this is just to make sure that you know who else is on the call. Really, we've got this broken down into the different asset sides of the financial institutions. We also do have some service providers that are on the call today. And then we do have live results. Again, we're going to show about 30 seconds of results here, but you should be able to see if you text your answers A, B, C, D, or E relative to each of those answers, what the mix of institutions are on this webinar. And the reason is Brett and I give presentations from time to time, and when you have a broad audience of different asset sizes or different functional areas of an institution that are on a call, it's sometimes difficult to get a message that resonates all the time with everyone. So just wanted to get a participant profile here.
And with that in mind, just keep in mind that we've done everything that we could to have kind of a general and broad and pertinent conversation for a variety of different asset sizes. So we hope we can accommodate that today.
So just wrapping up this poll, it looks like we do have the majority of the institutions that are on the call right now are financial institutions between 100 and 500 million in assets. We do have a couple that are a little bit smaller, under 100 million. But as we get started onto the next slide, really what our question is what is your view on the economy and the next several years? So this poll, again, is going to use the letters A, B, C, or D, and looking at when is the next recession likely to start. As financial managers in the institution, you're constantly making decisions on credit risk in the loan portfolio, or how aggressive do you want to be in adding loans? How aggressive do you want to be in pricing up deposits or taking on long-term funding given an economic outlook? And so just curious as to the participants on the call and what your thoughts are when the next recession is likely to start. So it appears we don't have anyone going out on a limb saying, no, this time is different. We are never going to have a recession again. So really kind of a split decision. If we look 2020 or 2021 and later, Brett, I think if we look at economic forecasts and kind of the consensus that is out there, most economists would say 2020 is probably when we're going to wrap up or get to an ending point in this economic expansion.
Yeah,
would that be right?
And I think that's become kind of clear here in the last month as certainly we've seen the equity markets react to the Fed again raising rates and talking about a communication of more rates to come, kind of on an autopilot situation, and with the fear being that the Fed maybe, as they have done in the past, maybe forcing a recession upon us by flattening the yield curve and potentially pushing rates a little bit higher. So that, coupled with another round of elections as we head into the presidential cycle around 2020, I think there's some thought that consumer sentiment, as an example, potentially could drop from the levels that we're at right now.
So the reason that we bring that up is we do want to look at the Treasury yield curves. We want to look at what the Fed is projecting and what the market is expecting, because that does give us a positioning into next year as to, what do we want to set ourselves up for balance sheet wise? Do we want to be asset sensitive, liability sensitive? Do we want to make some shifts in our institution's risk profile given that economic outlook? So just starting here on the Treasury yield curves, one thing that we like to show is where were we a year ago? That's the red line. And you can see since then, we moved up to the blue line as of 3 months ago. And that movement effectively would have gotten us to a point where we saw nearly a 75 basis point to 100 basis point yield curve shift on the short end. And then we got another 25 basis points since then, moving up to the green line, which is the most current. The 10-year Treasury hovering in the 320 to 322 range. So after the election, really not a lot of change in the 10-year Treasury, but certainly a flatter yield curve than where we were a year ago, and rates are up. So as we look at where do we go from here, the concern is a flattening yield curve, particularly for financial institutions. Generally, one of the ways that financial institutions make the most money is on the margin side, and the margin squeeze being there between the flattening of the yield curve with the Fed raising rates, but really not seeing that same amount of lift on the long end of the yield curve. The yield curve comparison that we have here is the 2-year Treasury versus the 10-year Treasury, and that's the point that we're looking at for the relative flatness of the curve. So we're getting to a point that we're approaching zero, and what you can see on this chart is the vertical shaded bars, and this is going to be the same for subsequent slides. Those represent recessionary periods. And generally speaking, when we look back to previous recessionary periods, we get to a fairly flat or inverted yield curve about a year in advance of recessionary times. So we're not quite there yet, but certainly we're getting closer to that point. The next slide that we want to look at is what happened last time. So there was a lot of discussion about what did the yield curve look like previously, what was the last time that we saw a flat yield curve, and so we ran 3 different time frames to see where was the yield curve back in 2005. You can see on the green line, the yield curve was fairly flat in 2005, and then we did get a movement up, almost a parallel yield curve shift and a flat curve up to the red line to June of 07. But then between 07 and late 08, we had a sharp decline in rates. And so again, as we look into this cycle ending in the next several years, we certainly could get to a flatter yield curve, and one that kind of gyrates around slightly, but a fairly flat yield curve around 3%. And we easily could get back to the points that we saw in 2008, given the Fed's desire to have some ammunition to drop rates if the economy decreases or goes into some slower growth or recessionary times. We also like to look at then the Fed funds futures versus the Fed's dot plot. So the Fed's dot plot is what they put out every quarter. This is updated through September, but then we also look at Fed funds futures and see where live contracts are currently trading in the market. And what we can see, and I'll see if I can use a highlighter here, the Fed funds futures last, this is indicating the 2018 year-end Fed funds rate. And if you remember, the Fed funds rate today is a range between 2 and 2.25. And so we basically get that middle point at about 2 1/8. And so if the Fed raises rates one more time, they get to that 3.375.
2.37.
Or 2.375, I should say, that they are indicating as their year-end target. The market is not far off of that. So the market is pricing in a very good likelihood that the Fed would raise in December. All indications would show that the economy is doing fairly well at this point and could afford a Fed rate increase in December. Now, there's some discrepancy when we get into 2019 between the Fed and the market. The Fed would like to raise rates 3 times next year from the year-end number this year, and the market is saying that they think a little bit more than 2. So the market is not quite in agreement that the Fed should move as quickly as they're alluding to per the dot plot. And then really when you get into 2020, the Fed looks at continuing to raise rates, adding one more rate hike in 2020. The market is saying no rate hikes in 2020. So the market is certainly viewing things a little bit more pessimistic than the Fed, and certainly concerned that the Fed is going to overshoot this time around and raise rates more than what they otherwise should. And that could lead us to a flat yield curve. And so the debate that we have, generally speaking, in ELCO meetings with our financial institutions is, where are we in the economic cycle? And so you hear different arguments as to where we are in the cycle and why this time could be different. And so looking at this chart, this is a cumulative look at real GDP growth, and we have this broken down by sectors or segments between recessionary periods. So you can see back in this period between in the 80s to early 90s, the cumulative growth between the recessionary periods was 34.6%. If you look at the period in the early 90s to the early 2000s, that period saw cumulative growth of 41.5%. The next section after the recession in 2001, 2002, we saw a growth of 18.5%, so a much slower growth during those years in that recovery. And then the most current is the longest expansion or recovery on record, or it will be getting there early next year. We're only at 17.4% cumulative growth. So it has been slow growth. And the question ends up being whether or not that slow growth means that we could continue doing more slow growth for some time. Household obligations as a percentage of disposable personal income, we took this one a piece of information from the St. Louis Fed and the Fed website, but looking at how are households doing as a financial indicator. And you can see that the debt levels, or the amount of debt as a percentage of personal income, and this is something that had dropped after the last recession and really looks pretty good. But the note that we have there is it does not include student loan debt, and I know that there's a whole nother story there. So from the standpoint of households, generally speaking, the consumer is fairly in fairly decent shape. And on the next slide, you can see consumer and business confidence. This is another reason that things look pretty good as we go into 2019 and finishing up on 18, is that we've got very strong confidence. So consumer confidence is near the levels that we saw back in the late 90s. And then business or small business optimism, if you look at that index, it really is at a high point going back to 1993. Now, I think, as we look at some of this data, one of the concerning things is if you look back in history, consumer confidence and business confidence tends to hit their highest points, generally speaking, right before we fall into a recession. So you've got this sense of euphoria before we fall into some harder times. Again, not saying that that's where we're at, but things look good right now. The question is, how long can this consumer confidence last at these levels?
And I think the other thing you can see historically is that the blue line here being the consumer confidence, you'll see that it kind of grinds higher over time, and I'd postulate that this is probably close to what a stock market graph would look like as well. But what you do notice is when things turn, they turn pretty quickly, and they turn generally pretty severely. So we could be moving along just fine, as Marc had just mentioned, but sentiment can change pretty quickly, and things can turn on a dime, and that's what we've seen.
So the other piece, when we look at why this might be more late cycle, is the unemployment rate and where the labor market currently is at. And you can hear this all over the place. And generally speaking, our financial institutions talking with their customers are hearing from businesses that it's very difficult to hire and it's very difficult to find workers. And that's reflective of the unemployment rate being as low as it is. Again, we plot this back, and this goes back to 1950. The green arrows are kind of the low point in the unemployment rate. What the question mark off to the right-hand side is, we don't know if we're at the low point in unemployment, but we are certainly at a very tight point for the number of workers that are available to take the available jobs. So again, this is another metric that tends to bottom out about a year in advance of a recession. We just don't know if we're at the bottom yet. So we certainly could have lower to go on the unemployment rate. We could stay there for a little bit of time, but generally speaking, the labor market is fairly tight, which is pushing up wages, which is certainly one of the concerns that the Fed has.
Yep. And there has been some times, back in the late 80s, I think it was, and in the 90s, where we did kind of just bounce along for, an extended period of time, longer than normal. And that certainly could happen this time as well.
Yeah, and one of the reasons that you can see on the next slide, looking at productivity on per worker, is that during those times where we had the unemployment rate kind of bounce around at lower levels, the amount of productivity by each worker was increasing at a fairly substantial rate. Where we're at right now is that we're kind of getting to an upward trend, but a slowing pace of gain. So the amount of output that we get per worker isn't increasing as rapidly as we saw in the 90s and the 2000s, when there was a lot more adoption of technology. And so while other periods in time we were able to have a labor force that continued to get more and more productive, that could continue to occur now. It just does not appear that that is bearing out in some of the information or the data as you plot it out. The flattening yield curve we mentioned before, and unemployment rate, this is just another chart that has both of those on it. But basically, you can see the Fed looks at their indicators of where we are in the business cycle, and those are two indicators that they look at, kind of getting us to more of a late cycle feel. A flattening yield curve or inverted yield curve generally gets us there. Some will argue that the Fed is artificially pushing us there, and their bond purchases or their investment portfolio has kept long-term rates down artificially. That's for another day's debate. But the unemployment rate is very low. So these correlations are certainly been there in the past, and this time certainly could be different. From the regulator standpoint, and we'll kind of touch on that when we get into the asset liability section, but real estate values have moved up. This is just a snapshot of real estate values, generally speaking, on the commercial side in the Midwest. And you can see that multifamily, and this has a basis back in 2000, but multifamily has grown pretty substantially in value. And you can see that retail as well as industrial is moving closer to the peak that we saw back in 06. So if you've had a regulatory exam, one of the concerns that examiners have is values are up quite a bit. And how does that look if we do get into a downturn, or if we just don't have the appreciation in some of the values? How does the loan portfolio look if we do have a little hiccup and values start to tip back to where they were a couple years ago? The median U.S. Housing sales price also has moved up pretty dramatically since the last recession. And now we are hitting a point where the median U.S. sale price is dropping a bit from the high point. So again, somewhat of a late cycle indicator. Doesn't mean that we're going to see the impact that we saw back in 2007, 2008, and 2009 with the decrease in home sale price, but certainly not seeing the appreciation now that we've got mortgage rates up as high as they are.
And another concern that's out there in terms of housing is housing has been a leader, for the last, call it 4 or 5 years. And the fact that interest rates have come up, and we saw 30-year mortgage rates hit 5% there for a period of time, they're probably around there right now. There's some concern that's throwing some water on a relatively hot part of the economy, and that would be something that the market's looking at in terms of being late cycle as well.
Yeah, and one of the last things that we have here, and while we are not stock experts or stock market experts, we'll just point out the S&P earnings and how that relates to the S&P 500 index levels. Basically is that you can see that during or right before recessionary periods, you actually see a drop in earnings. Right now, we are not seeing a drop in earnings or really earnings expectations for next year. We are seeing a slowing in the growth. However, so this would be something worth watching is, are we late in the cycle or are we mid-cycle? One of the concerns in the stock market right now, if you watch that, is, are we hitting a point where at peak earnings? And that's a real debate as to whether or not companies can continue to expand profit margins and earnings, given the amount of increase that we've had from tax reform and other benefits that they received this year. Does that continue into next year and beyond? And that's similar to what we'll look at with bank earnings as well. Can you continue to have as good of a year as you had this year? Again, this next slide looks at the revisions, upward and downward estimates on earnings, and really there's been a slight negative or downward revision trend versus up revisions in earning estimates. So that's one of the reasons that the stock market had a little trouble in October, rebounding now after the election as well. And lastly, we've got corporate debt as a percentage of GDP. One of the things that a lot of corporations did, larger corporations, was issue a fair amount of debt in order to fuel buybacks and dividend payments during this last cycle. And over time, the amount of corporate debt has continued to rise. The concern is that if the Fed continues to raise rates and we see interest rates rising and all of this debt needs to be refinanced, does that cause any challenges for these companies and earnings? Certainly that could be an indicator or a challenge for corporations to continue to grow earnings if they do have higher interest expense on the debt outstanding. And then finally, we did have a customer that was looking at, well, last time around, what happened to the Fed funds rate and how much did the Fed actually drop rates and where did that fall versus where the 5-year Treasury yield was at? And interestingly enough, this goes back to the late 80s is where we're pulling this, and you can see, the green line is the effective Fed funds rate. And what you can see is once the Fed gets in a tightening cycle, they usually raise rates. They maybe stay at a top for a period of time that might be a year to a year and a half. And then when they decrease rates, they don't usually decrease them by 25 basis points or 50 basis points. They move in quite a large fashion. And so the question is, as we prepare for the next time around, what might that look like if the Fed gets up to 3 or 3.25 on the Fed funds target rate? Will they then drop back down to 1/4, or will they just go down to 3%? We think there would be a good likelihood that when they start cutting rates, they might cut them more aggressively. Again, we don't know what the reason would be that they'd start doing that, but history shows that it's hard to forecast the reasons that we go into recession. Relative to the 5-year Treasury, generally speaking, the 5-year Treasury ends up peaking out before the Fed funds rate gets to the highest point. And so again, as institutions are looking at how do we manage the investment portfolio today and what should we do, it's very easy to look at it and say, well, interest rates are rising. Well, that is true, but that's also priced into the market and priced into the 5 and 10-year part of the yield curve. And so it may be a possibility that the 5-year already has much of the rate hikes built into it. And that leads us to the rate forecast that as you're looking at a takeaway, as you're looking at putting together a budget for next year, using a survey from the Blue Chip Financial Forecast. This is just a survey of economists. We have it graphed in the middle, along with a chart of a couple different key driver rates. But the Fed funds rate is expected to move up from 2.2 up to 2.9% by the fourth quarter of 19, with the 10-year Treasury moving up from 3.1 to 3.4. So again, the story du jour is a flatter yield curve. And how do financial institutions manage going into a flattened yield curve? And so we asked the question now, another poll starting, have we changed your mind? Do you have any difference of opinion on when the next recession is likely to start? Maybe we'll start to see somebody put a never this time is different with some more optimism there. But certainly, again, we're not here to call the next recession or say when it's likely to stop. the growth stop, because a lot of what you might experience in your own financial institution is going to be local economics. And so all of the information that we just went through is going to be related to the national economic picture, which would be relative to what the Fed is doing and what market interest rates might do. Your specific economic area is going to be based off of what kind of development is in your area. Do you have big projects that will continue to drive growth? Do you have population expansion? That can weather the storm a little bit different than areas that are just hit with things like ag, for example, which is really struggling. But right now, again, look at the percentage of respondents. Most are still split between maybe 2020 and 2021. We got a couple of people thinking that next year is the year that we're going to have a recession. So certainly we'll talk about ways that you could prepare your balance sheet for next year. That's the purpose of this call. But wanted to walk through a little bit, and I'm going to hand this over to Brett to walk through the investment portfolio strategies and really some thoughts that we've got as institutions prepare their investment portfolio for 2019.
Yeah, so just taking a snapshot, and we understand that we've got both banks and credit unions on the line, so forgive us if we just say only bank and not credit union or financial institution, I guess is what we'll try to say. But just taking a look at year-to-date income through September, just via the FFIEC website, looking at banks, which turns out to be kind of the group that we're talking with on the call here today, $300 million to $1 billion banks. The ROA on a sub-S adjusted basis for the first 3 quarters is 1.15%, up from 96 basis points last year and up from 94 basis points 2 years ago. So if you take a look at that, 19 basis points of increased ROA on a $500 million bank, that's $950,000. That's a meaningful amount of money. Nationwide for mutual savings banks, performance is also up year over year, 6 basis points year over year, translating to $300,000 on a $500 million bank. So as we're in meetings with boards and with ALCOs, they're looking at the great year that they're having this year relative to last year, looking at the economic outlook and starting to think about, are there ways that we need to kind of position ourselves for potentially what could be a tougher year with margins probably coming in from a funding perspective, cost of funds going up, that sort of thing. So we have seen a fair amount of selling out of investment portfolios. Obviously, with interest rates moving up, the unrealized gain loss position has moved south for just about everybody out there, and so it's turned into a situation where, okay, we need some liquidity. Our loan demand continues to be solid. Gathering new deposits is becoming increasingly difficult and increasingly costly. So liquidity trends have moved down. So the investment portfolio has turned out to be a source of funds for many banks that we're working with. This is just a simple example. Again, just an illustration of something that we've seen here recently. A bank that had some relatively lower yielding agency bonds with a book yield of just a 193, and they had loan demand. So their decision was to go ahead and sell the agency CMBS, take that loss, but they're able to put on a 4-year loan rather than an investment security. So the loan for them was a 5% yield on a 4-year term, which equates to the incremental yield of a 307. So when you look at trying to recover that loss of $145,000, the fact that it's moving into loans obviously helps that recovery time. So it's basically a 1.5 year recovery time on a 4-year bond that you sold at a loss. And if you compare that to other cost of funding, quote unquote cost of funding, the sale of this bond was at a market yield of a 326. So that's really your comparison to your alternative sources of funds, which would be a brokered CD or FHLB, kind of in the same ballpark. So this was a strategy for a bank that, from a capital perspective, didn't want to grow the balance sheet anymore by going out and taking wholesale funding, but they viewed the investment portfolio as a source of funds. That's something that we've seen really for the last 6 months. It's been a pretty common occurrence.
Yeah, and really in something like this where an institution is doing fairly well this year and feeling like they're going to be challenged a little bit into next year, they're willing to take that loss of $145,000 and take that book yield of 1.93 off their books, improve their margin going into next year, because now they're going to be looking at a yield of 5% instead of the 193, and certainly look at a better return on assets in 2019 just on these dollars. So again, kind of small things around the edges that institutions are considering. This again, if an institution had strong loan demand, we certainly have other options where banks are just looking to restructure, given that there's low yields in the investment portfolio as well.
Yeah, so for the institution that doesn't necessarily have that strong loan demand, but yet they're looking at a very solid 2018, kind of wondering where it's going to come from in 2019, something that we're very active here in the fourth quarter with a number of different institutions, is a repositioning in the investment portfolio. It's the exact same concept as what we just talked about, looking at the portfolio, looking at relatively low book yielding securities, determining kind of where you are versus last year, where you are versus budget or versus plan, and is there some room to take some losses in the investment portfolio, bring yourself maybe back down closer to plan, not quite as much over last year, try to smooth out the earnings a little bit. So this is a situation, obviously, if you're going back into investment securities versus loans, the payback period is going to take a longer period of time just because the yields aren't equivalent. But the way that we look at this is, as long as the time to recover the loss that you're taking is shorter than the bonds that you're selling, economically it makes sense to do. And it just boils down to how much would you want to try to move earnings from this year to future years.
And in this example, one of the things that we can highlight is there's no magic formulation of income. There is a reason that you're getting more income on the pickup versus what you're selling. The reason is that we're selling a duration of 3.18 and we're going into a duration of 5.79. So again, as we go back to the polling questions of participants that are on the call and where they think the economic outlook is, for those who think that we're going into a recession in 2019 or even into 2020, they may look at it and say, I expect that interest rates are maybe going to be lower when these first set of securities come due in a couple years. I want to take that loss today and I want to push those maturities out on the curve and lock in that yield as long as I can to help weather the storm that I see with dark clouds on the horizon. Again, not what we're thinking necessarily, but certainly an institution that's looking to protect future earnings, that would be one of the considerations of why you might want to extend the duration as well.
So in this scenario, we're showing a sale of agency commercial mortgage-backed securities. Another very viable sale candidate, especially if you're a C Corp, is BQ municipals that have rolled down the curve. So really anything, Mark, I don't know, inside of probably 4 years makes a fair amount of sense.
Yeah, definitely in the
source.
2 to 4 year range looks fairly good.
Yep.
So now we get to a poll question, and really this comes from other bankers ask us, and they always want to look at, well, what are others doing? And just curious for those who are on the call, we've got the number of attendees. You can see, what are others thinking, and have institutions actually pursued strategies of selling securities for a variety of reasons? So we're going to ask you to share. All of this is confidential, so not putting names out there saying, what banks are doing what, but, just looking at how are you using the investment portfolio and how are you managing that relative to your loan demand, relative to the outlook for income next year, and then just considerations. Again, many institutions now that we see, are really waiting to get a better view as to what year end is going to look like. They've got budget goals and they have reasons that they want to hit certain numbers. And so they want to make sure that they hit some minimum income numbers to maybe hit management targets or stockholder targets. And they're willing to start looking at it a little bit closer to year end once that's formulated. So now that we're in November, there's a lot of institutions taking a hard look at this.
And the other question we often get when we're discussing this is, what of the timing to do it? Should it be something that I do all at one time? Should I, wait for yields to move one way or the other, or should I do it over a period of time? The answer is we've seen that all. Mm-hmm. We've had customers who have embarked on a strategy here over the last 3 months that have said, I've got, here's the dollar amount that I want to do. I don't know what the market's going to do, so I'm going to do a third, over a 3-month period. Or we've had others that have said, I don't know what tomorrow's going to bring. I know what the numbers are today, so let's go ahead and do it. And then there's others that have a feel that rates are moving one way or the other, and they think it's going to be advantageous for them to wait. What I would say is, in terms of as the calendar moves throughout November and December, obviously the number of working days, kind of diminish a little bit. The week of Thanksgiving is very difficult, and as you get into the back half of December, the reality is that liquidity in the fixed income marketplace does pull back a little bit. So for the 73% here that are saying they may research it further, that's what I'd just give you some advice in terms of timing of how to go about it.
So now Brett's going to go through a little bit of, in the investment portfolio, if we look at what's in the portfolio and what would we look at buying today given the economic outlook. Certainly the concern would be trying to lock in and protect earnings into the future. And with that, Brett's going to walk through a couple different security types and something worth considering for your institution, or just some broad comments on the market in general.
Yep. So the first thing we're going to talk about is new issue callables. And really, one of the strategies that really did not work well going through the last recessionary period and after was portfolios that had a high concentration of new issue callables. And the reason for that, obviously, is virtually all of those securities refinanced lower as rates dropped. And not only is it a problem that you have to reinvest at lower rates, but if you think about a recessionary period and shortly thereafter, loan demand really doesn't come back until it's evident that we're out of a recession. And that can be varying periods of time. However, the agencies are very quick to call bonds. They're very, very efficient. So the banks that we saw that had kind of below peer performance were ones that had very callable securities that they really had no other option but to reinvest at lower rates. So this particular example, this is a 7-year, 1-year, a new issue with a coupon of 3.45, priced at par. And really what we want to get into is the difference between spread and what the kind of option adjusted spread that you're actually receiving in a bond like this. So this bond at a 3.45 yield has a gross spread to treasuries of 66 basis points on the surface.
And just for reference, this was put together in September, so this is not a live offering at all.
Right, exactly. It's just for illustrative purposes. So on the surface, plus 66, that seems like a pretty good spread. But the true question is, what is the value of the call option that we're given to the Federal Home Loan Bank? And that's where we turn to option adjusted spread. So what we're trying to do here is get a value of exactly what that option is worth and what are we giving up for what looks like a relatively high yield. In this particular instance, you can see the option adjusted spread turns out to be 30 basis points versus that growth spread that we looked at on the previous page of 66. So the cost of what you're giving to the Federal Home Loan Bank for the incremental yield that you're seeing on that par bond is actually 36 basis points.
Yeah, so a different way of looking at that is the option free. So if there was no optionality at all, the yield would be a 309, which is a spread versus treasuries of, right in that plus 30 range. It is boxed in right in the middle. And so now compare that, Brett, to a discounted callable as an alternate. If you were staying in the callable agency arena,
right.
This is why maybe something in the secondary market might be more attractive, even if the gross yield is lower.
Right. So this is slightly longer. So this would be a 7.5-year bond versus a 7-year bond, but it's in the same ballpark. It's callable anytime. You can see the coupon on this particular bond is a below market of 262. But obviously, as a result of that, you're going to purchase that at a pretty deep discount. In this case, a 95 handle discount. The spread there is 47.5 basis points. So obviously below the 66 basis points that we saw for the par price bond, but still better than the option adjusted spread on that par bond. So from our perspective, this is the type of bond that in a lower rate environment, if rates were to move lower, at least this bond will stay on your books, number one. if it does get called, you have a fair amount of upside from the standpoint of you have a $95 price that gets accreted to par. So this is a way that you can take some of the risk, kind of de-risk the long-term earnings potential of a portfolio just by the type of coupon and type of structure that you buy within the agency space.
And again, that was more of an example of if you want to stay just with U.S. government agencies that are not backed by any other collateral, that would be the CMBS that we're going to go through has some different structure, still agency guaranteed, but it's not straight agency debt.
Right. So another sector that we like, not only as advisors but also our own company likes, is the agency commercial mortgage-backed space, and those are simply securities that are backed by multifamily structures. Ginnie Mae also has some what are called project loans, which will be backed by multifamily, but also nursing home and healthcare and those types of things. The reason that we like these is that they will come with prepayment penalties, which make the securities much more bullet-like relative to residential mortgage-backed securities that, again, as rates fall, can potentially prepay if the homeowners decide to do so. With the CMBS, at least economically, there's some prepayment protection there that makes these things pretty attractive. I alluded to the fact that our own company likes these securities, just highlighted there in yellow. You can see we've got about 32% of our par value in our investment portfolio dedicated to these types of securities. So our money truly is where our mouth is.
Yeah, and you can see on this holding, we've got the top 25 holders by dollar amount, and certainly I would point to some of the largest banks in the country, Bank of America, JP Morgan Chase, and the volume that they own of these types of securities is large, but as a percentage of the portfolio may not be as large, only because they've got huge investment portfolios. So we give you just a view of there's a lot of institutional and large money managers as it relates to bank investment portfolios that are buying these securities and like them for the variety of reasons that Brett walked through. So walk through an example for us that we have on the screen here.
Yeah, so one thing that we like today are discounted Fannie Mae, what are called DUS bonds, and DUS stands for Delegated Underwriting and Servicing. All that means is Fannie Mae has a collection of, I believe it's 24 underwriters throughout the country who are able to, they're authorized to underwrite, close, and deliver loans to Fannie Mae based upon agreed upon underwriting standards. So that's what DUS stands for. But this particular bond, again, if you think back to the callable agencies that we were looking at, this is also a 7-year maturity. It has 6.5 years of yield maintenance prepayment protection. So what that means is if the borrower does prepay this loan, they're subject to a yield maintenance penalty over a period of 6.5 years. This particular bond is priced at a discount, which is something that we find important because in theory, these bonds, even though there's prepayment penalties, they can prepay at any time. If the borrower refinances, takes out equity, if the borrower defaults, obviously it's going to prepay at par. So to the extent that you can find these types of bonds at discounts, that is truly our preference. The spread on this, you can see it's in line or better than the discounted callable, and it beats that option adjusted spread that we talked about in terms of the new issue par bond that we talked about.
Yeah, and on the right-hand side in the prepayment penalty, effectively today, when we look at where interest rates are at, and the yield maintenance is really going to be looking at where the current interest rates at versus the rate of the security or the underlying mortgage, but the current penalty is 206. So if this got paid out today due to a voluntary prepayment or a refinance on the underlying mortgage holder's decision, that you as the investor would get paid out at a $102 price. You're buying it at 99.64. Mm-hmm. So that is one of the benefits. That's one of the reasons that our portfolio likes it, is that you actually get a little bit of that, the piece of that prepayment penalty as well. And we have seen, some of our investment portfolio customers recognize that income as well. So we've actually seen it in action.
Yep. And the other thing that's interesting about this collateral is that these will refinance not necessarily for what you would consider to be economic reasons when you're looking at the rate that the borrowers are paying. A lot of times we'll see bonds that get prepaid that the market has at a of unrealized loss, basically. And the reason that it's prepaying is because the borrower maybe sold the property, maybe they're taking equity out to do the next deal, that sort of thing. So that's where the discounted dollar price comes in handy. But it's also been, here in the last year, it's provided some tailwind for some bonds that have been prepaid, where they were held at relatively low book yields, but they get prepaid at par. So you're eliminating an unrealized loss situation, getting paid at par, and now you're able to reinvest at current market rates.
And certainly that's a function of that. In the economic section, we looked at the property values, at least as it was related to multifamily, and those values have risen significantly. So cash out refinance is certainly something that, even paying a penalty or getting out of those loans, it was worth it to the underlying mortgage holder to refinance that deal. Again, not a guarantee that that could happen, but it has happened with some of these securities to the benefit of the banks that held them.
Yep. And the final thing, just in terms of analysis between the callable agencies and CMBS, is what happens to the market value of these types of bonds in varying rate environments. On the left-hand side, we've got a 4% coupon, priced at par, 2028 final. And what we're trying to show here in the graph is kind of rate shocking, down 150 basis points or up 150 basis points. What happens to the price of these bonds? And the big difference you can see on the up cycle in terms of rates going up, they move relatively the same because it's a function of the duration of the bonds. You know, they both have 2028 finals. It's just simply a mathematical equation on the upside. However, if rates fall, the price appreciation of a callable is capped because the market's expecting that the bond's going to be called. So the impact of that over a horizon period of a bond is a dramatically different yield experience that you would receive. So you see the dust can continue to appreciate as rates fall. Now, again, we would not advocate in that situation to be buying a bond like this at, say, 105 or 109, in this example. We'd probably be sellers at that point because the loan, again, can prepay at any given time. But the bottom line is that over a period of time, the average yield, there's a massive difference between the average yield on the horizon if rates are to fall.
And that's really where, again, getting back to your economic view, if you look at it and say, well, I think the economy is going to do great, and I think interest rates are going to do nothing but go up from here for a substantial period of time, that new issue callable agency at 4%, you may not view that downside risk as a high potential. So you may just want to get the extra yield of getting the 4%. However, we would look at it and say it's probably worth giving up a little bit of yield for the protection, and that certainly goes to the overall balance sheet, and that's what we'll walk through next, is a little bit of the best practices as we see asset liability management and things to consider into 2019. You know, certainly the examiners that are coming out are going and talking to institutions about a variety of different things, but the examiners are concerned about what they're seeing out there with institutions lending fairly aggressively in what they view as the late in the economic cycle. So again, this is things that we're hearing from banks that have experienced exam cycles and what they're hearing from their examiners and concerns, also from the FDIC and others that we read publications. Real estate prices are at peak or past peak levels. Certainly the agriculture sector is weak and has a challenging outlook. And so a lot of banks that are exposed to ag are experiencing that in their loan portfolios right now, really working through managing the credit side a bit more. On-balance sheet liquidity is falling, where banks institutions are using up that on-balance sheet liquidity excess portfolio and converting that into loans, or they're going out and using a lot more in the way of wholesale funding. So the combination of that kind of feels very similar to the last time around to a lot of examiners, and so they're concerned, and they're saying, all right, really start taking a look at your different policies, procedures, your ALCO process. And what we would say is, you know, it's a good time when you're going through your budget to start going through and evaluate your process to see, you know, are the assumptions that you're using in the model quite accurate? One of the ways that you can do that is prepare a backtest of model results. So you can basically see, you know, was the experience as it related to yield and forecasted rates in line with what we would have expected given what the market rates did. So that would be 5-year Treasury, Fed funds. If we knew exactly what the market rates were going to do, how closely were our assumptions on pricing and prepayments and some other key assumptions. and then adjust any key assumptions that aren't in line with current practice. So one of the things that we're seeing a lot right now is banks that are really struggling to try to find deposit growth. And so they're paying up fairly aggressively and they're paying very high rates. We just want to make sure that the key model assumptions are in line with the practice of raising rates. And if your experience is that you're going to raise rates on all of your balances of money markets, for example, that should be in line with what the pricing betas are. One of the other things that examiners like to see is run alternate scenarios to stress key assumptions. The reason for that is you have a base set of reports that you're making decisions off of. You've got your interest rate risk position, whether it be the rate shock of income or the rate shock of market value. Well, that has a lot of assumptions that are baked into it. Well, what if those are wrong? How different could our results be if the assumptions were actually different than reality? And then finally, independent model validation is somewhat of an exam requirement at this point. So examiners will request or ask when the last independent model validation was completed. That can be completed by a third party, such as a company like ourselves, so there's many others that do that. Or if your institution is big enough and you have somebody outside of the ELCO process, whether it be maybe an internal audit individual that would be well-versed in going through the ELCO material, they can do an independent model validation on kind of off years as well. Just give you a few key assumption stress examples. So key assumptions that are generally in the model: decay rates on the deposit side, cut them in half by 50, or cut them by 50%. What do your results look like if that's the case? Pricing betas. What if our deposit betas are 25% higher? And then prepayment speeds. You could eliminate prepayment assumptions or slow them significantly. And just look at what the results are. They don't necessarily need to fall within your risk parameters, but you do want to see what the experience is on the assumptions. The other thing that I didn't note there was loan spreads. So when we backtest and we're looking at where were model assumptions off this year relative to where we thought at the beginning of the year, it's on loan spreads. So one of the tables that we have here is where the current interest rates on the Treasury curve are relative to where they were a year ago, 3 years ago, and 5 years ago. And we just give an example of, if you wrote a note at 4% 5 years ago, that would have been a spread to Treasuries of 257 basis points. So today you would need to be renewing that note at 5.53% to maintain that same spread. And really what we saw throughout the course of this year was that institutions really struggled to keep credit spreads the same as what the renewing loans were at. And so their pricing betas on loans were significantly less than 1. And so going into this process, many banks thought, yeah, we're going to be able to pass through those costs or those higher interest rates to customers. Competition hasn't quite allowed for it. So getting back to our poll question, just curious, and this is more so for the other participants on the line as well, so that you can see, has your bank experienced loan spread compression over the last 2 years? And just get a gauge of where are other financial institutions and who's experiencing, who isn't. Certainly there's not names here, so you're not going to say, whether or not banks are experiencing it in your market or not. But anecdotally, that is certainly something that we've been hearing, and it continues to persist. I'll give a couple more seconds to look at the results, but it looks like by and large, more institutions saw loan spread compression this year and the year before than not. And for the 8% that aren't sure, certainly something that would be worth going back to the loan department and try to get some more information as to what they're expecting for loan spreads. Because if you're in charge of putting together a budget for next year, loan rates are certainly key to trying to put together a forecast, as well as what our interest rate risk position would be.
And Mark, it's fair to say that we kind of view that as one of the biggest risks to meeting plan or having a great or a better 2019 than 18 is the combination of a flattening yield curve, in our mind, compressing loan spreads, and kind of the unknown of the deposit side.
Yep. Yeah, certainly the deposit side, a lot of institutions have been able to lag deposit rate increases, and they're starting to accelerate quite a bit today. And so given the fact that the loan side is still not repricing up one for one, you're kind of getting hit on both sides of the balance sheet. And so most institutions kind of went to the investment portfolio and said, in order to make it up, I'm going to take it out of the investment portfolio and put it back into loans. Again, that gets examiners a little bit uncomfortable as they look into next year. The next thing that we want to do is look at the non-parallel yield curve shift. So we talked a lot about, where are rates today and can you run non-parallel scenarios? Here's an example of one that we would run. The current rates are the red line. We would say, over the course of the next year or 2 years, what if we got up to a flat yield curve at 3.25%? That's really what the market is forecasting. How does that rate shock look relative to the standard examiner requirements of a immediate and parallel rate shock, which means every part of the curve moves 1 for 1. The other thing would be to look at is a scenario like that 2008 line that I've built in there. It's a custom scenario that we can build, but it would be dropping rates then back down to what we saw at the low point in '08. So if we moved up and then came back down, what would your institution look like? The other thing that you can do is, whether or not your model allows for it, you could run a balance sheet simulation, which would forecast out what your income would be if that scenario took place. So right here, just looking at Fed funds and 5-year CMT, effectively does get us up to that point where, Fed funds gets above 3 to 3.25. The 5-year gets about 3.30. And then once we get through 2020, the 5-year starts dropping, and then the Fed starts cutting rates at the beginning of, or the late 2020. So what happens to the balance sheet? We use a sample institution, about a $425 million institution that's asset sensitive, and really looking at the results on a static balance sheet. And what you can see here is their change in interest income, or net interest income, is positive in 2020 as rates are rising. In 21, it somewhat flatlines from there. And then in 22, when rates are dropping, they see a significant decrease in their margin. So those are real dollars for this institution, almost 10%. And looking at the loan to asset ratio, we're keeping that constant. The thing to consider here in the next scenario would be, this assumes a 12% portfolio decline. So in a downturn, our expectation is that banks and financial institutions don't have as much loan volume. They'd see that decline. They'd also see credit losses. That's not modeled in here, and we're not assuming any loans go into non-accrual. And so really just the impact of the combination of being asset sensitive as well as seeing a decline in the loan portfolio in 2021 and 2022, you can see the margin deterioration. So when we look at things in the investment portfolio, like we want to lock in yield, that's the reason it becomes important, is you really need that hedge in the portfolio to balance off what's going on potentially in the loan side. So again, one of the final things on the ALM process is assess your liquidity management process. This is one of the key things that regulators are asking about. Target your level of on-balance sheet liquidity, document the acceptable use of wholesale funding and what levels you're willing to do, and then run robust liquidity stress testing. If your institution is running with lower liquidity levels, I would make sure that you've got very good liquidity stress testing that runs adverse scenarios like loss of large depositors, eliminate contingent sources of liquidity. That would be unsecured Fed funds lines, brokered and internet deposits, and then increase collateral requirements at the home loan bank or others if there's a capital or credit issue. Those are all things that examiners expect to see in a stress test. And then finally, a potential independent validation of the liquidity management process. We're hearing that more and more, that examiners are asking for it. So again, the title of this webinar was, 3 key takeaways. We hope that there were a few more than that, so we do have them listed here, but kind of the key action steps that we would say is a takeaway from this webinar would be dissect your current balance sheet interest rate risk position and assumptions. So kind of look at forecasting current trends, what's happening with loan spreads, what's happening to our deposit pricing, how is that going to impact us into next year. That'll help make the decisions on whether or not you want to take losses in the investment portfolio this year, reposition into next year. And then run alternate scenarios for budget or forecast to quantify the impact of one of those negative scenarios like we ran on interest rates getting back to 2008. We'd also advise, adding floors or increasing floors on floating rate loans, and then structuring the investment portfolio with less prepayment risk, as Brett talked about. And then finally, if you do wholesale funding and you do need to term out brokered deposits, whether it's 3, 4, 5 years or longer, consider adding a call option. The bank owns that, so if interest rates fall and funding becomes less of an issue, you could call that away and you could refinance that issue, or you could just pay it off without any additional penalties. So that is a very valuable thing. You can see that the home loan bank and the agencies do it when they're selling you investment securities. So certainly adding it into the funding mix on your side, it would be of a benefit.
Yeah, and the pay up to do something like that is nowhere near the difference between a callable agency and a bullet agency. So I think it's a very efficient way to do that.
So finally, you're going to look at this picture and say, well, why the heck do we have a picture of a cool looking duck? And the reason is that every institution is a little bit different. And so while we try to give, some broad-based information, your institution may be completely unique, and you might have a different strategy that needs to be developed that's more tailored to what your experience is, what your goals and objectives are. And so what we just ask is, if you need some help or want us to look at something that is more detailed in line with what your institution is facing, we'd be happy to do that. Certainly, like I said, every duck is not the same and every bank isn't the same. So everyone's in a little bit different position. With that, we've gone through an hour of information. We do have a little bit of time for question and answer. And then at the bottom of this page, bokfinancial.com/institutions is the website that we can go to if you do want to find out any more information about us. But we'll open it up for questions. I think you can type them in on the webinar or GoToWebinar if you've got any at this point.
Yeah, thank you, Mark and Brett. We did have one question come through. What are your thoughts on bank qualified municipal?
In terms of the bank qualified market, obviously the tax law change at the end of last year changed the rules or changed the attractiveness for C corps with the 21% tax rate. Not as much of a change for S corporations. We see C corporations kind of selling front-end bank qualified munis, as I mentioned earlier, and the buying that we do see generally seems to be 10 to 15 years, where the spreads are 70 basis points out to maybe 120 basis points. For S corps, we see buying across the curve in bank qualified as those spreads continue to be attractive.
And we did have one question about CMBS securities, whether or not they could be pledged to public funds. That would be a question that you'd want to make sure that your agreements with your municipalities would include that. But generally speaking, we do see that because it is real estate related agency-backed collateral, that most institutions have been able to pledge that, and that the Home Loan Bank generally also accepts it as collateral.
All right. Any additional questions? Alrighty. Well, I just want to go ahead and thank you guys all for attending the webinar. As stated earlier, we will be having a recording of this, and we will able to send it to all of you guys. So if you need to go back and review some of the slides, or if you guys have any additional questions, feel free to reach out to Mark or Brett, and they will be able to answer those for you.
Thanks everyone for joining us. We really appreciate your time, and please reach out if you have any questions.
All right. Thank you.
Thank you.
Yep. Bye-bye.